What if I told you the entire tax system has been rewritten, and it doesn't matter if you're a student, a parent, a worker grinding overtime, or even a retiree, your money will be impacted. That's right. The rules you thought you knew about deductions, credits, Social Security, even how tips and overtime are taxed, have all been shaken up. Some people are about to save thousands of dollars every single year, while others might find themselves caught off guard with less than they expected. The scary part? Most people won't even realize the changes until it's too late, until they file and discover that their return looks completely different. So in this video, I'm going to break down who actually wins big, who loses, and what you must do right now to protect your money. And trust me, some of these changes will shock you. Welcome back to the channel. If you're new here, don't forget to subscribe and turn on notifications so you'll always have access to clear, practical insights on personal finance and the latest financial trends that shape your future. Let's rewind for a second. On July 4, 2025, this so-called beautiful bill was signed into law. And no matter where you land on the political spectrum, one fact is crystal clear. It affects every single tax filer in America. The biggest shift? Tax rates were locked in. That's right. Gone are the days of worrying about rates snapping back to the pre-Tax Cuts and Jobs Act levels. For planners, accountants, and families, this brings clarity. But it also forces everyone to think differently about their money. Now, let's talk about the group I like to call the messy middle. These are households earning between $50,000 and $150,000 a year. If that's you, listen carefully. The permanent lower tax rates, combined with a higher standard deduction, could mean annual tax savings anywhere from $500 to $2,000 depending on your exact situation. For some families, that's a vacation fund, a debt payment, or even a cushion against rising living costs. And that's not all. If you qualify for the child tax credit, the savings could grow even more. But here's the twist. While middle-income households see relief, the real winners might surprise you. So who benefits the most? Let's just say it's a group that politicians never forget, because they show up to vote. That's right. Seniors and retirees. The bill didn't go as far as making Social Security completely tax-free, but lawmakers still gave retirees a very generous nod. Individuals get a $6,000 sweetener, and married couples filing jointly get $12,000. That's real money staying in the pockets of people living on fixed incomes. But here's the trap. Just because the government is giving you a break doesn't mean you automatically get it. You'll need to make sure you file correctly and take full advantage of deductions and credits. Miss one, and you could leave thousands of dollars on the table. So what should you do about it? First, double-check every deduction and credit you qualify for. Keep better records than ever before, because the IRS is not going to call you up and say, "Hey, you missed something." Second, know your income phase-outs. Many of these credits and deductions fade as your income rises. If you're not tracking where you stand, you might be planning your finances on assumptions that no longer apply. And third, and this might sound controversial, consider hiring a tax professional, at least for the first year of these changes. Yes, I know many people prefer to file on their own, but when tax law gets rewritten this dramatically, having an expert in your corner could prevent costly mistakes. All right, let's dive into the actual policy changes, because this is where things get interesting. So let's start with tips. For the first time, there's now a $25,000 deduction for qualified tip income from federal income taxes. If you work in restaurants, hospitality, or any industry where tips are a major part of your income, this could mean a serious tax break. Now you'll still pay payroll taxes on tips, but when it comes time to file, you'll see some relief, provided you meet the income requirements. And speaking of income requirements, the phase-outs are pretty generous. If you're single and earn under $150,000, or married filing jointly and under $300,000, you qualify. For many service workers, that's a massive win. But what if tips aren't your thing? What if you're racking up long hours, grinding overtime to make ends meet? The bill thought of that too. From 2025 to 2028, overtime pay up to $12,500 for singles and $25,000 for couples is deductible for federal income taxes. That means your hard work doesn't just show up in your paycheck, it shows up in your tax return. But here's the catch. Just like tips, this deduction is temporary. If you don't plan around it, you might miss out when it matters most. Now let's talk about one of the most debated issues in the tax world. State and local taxes, also known as SALT. Back in 2017, high-tax states got hammered when the deduction for state and local taxes was capped at $10,000. For families paying property tax plus state income tax, that cap was painfully low. This new law raises that cap to $40,000, but only if your adjusted gross income is under $500,000. For many families in states like California, New York, or New Jersey, this could finally mean relief after years of frustration. Now, let's pause for a moment because after the bill passed, two big rumors started spreading like wildfire. First, people thought Social Security was going to be completely tax-free. Here's what really happened. The Social Security Administration sent out an email on July 3rd, before the bill was even signed, saying benefits would no longer be taxed. Naturally, people believed it. But once the actual bill became law, the truth was clear. Social Security is still taxable. Yes, the $6,000 and $12,000 deductions help, but they don't erase taxes altogether. So if you saw those headlines, don't fall for them. The second rumor was even scarier, that the new law was eliminating Roth IRAs, backdoor Roth conversions, and even the mega backdoor Roth strategy. Content creators jumped on this story immediately, but guess what? They were wrong. The bill doesn't touch Roth accounts. You can still do your conversions, you can still contribute through the backdoor strategy, and the mega backdoor option is alive and well, provided your retirement plan allows it. So, take a deep breath. If you were panicking about losing one of the most powerful retirement tools available, you're safe. At least for now. Here's the bottom line. This bill reshaped the tax landscape in ways that affect almost everyone. Middle-class families see moderate relief. Retirees score big wins. Service workers and overtime grinders finally get recognition. And high-tax state residents catch a break. But, and this is a huge but, none of this helps if you don't take action. The rules are complicated. The benefits have income phase-outs. Some deductions are temporary. And misinformation is everywhere. So, the best thing you can do is prepare. Track your income carefully, file smarter, and if you can, get professional advice at least this first year. Because while the government may have written the rules, how much you actually benefit depends entirely on you. Now, here's what I want to leave you with. Tax laws are never permanent. This bill is just the latest chapter, and chances are, more changes are coming in the next few years. The question is, are you ready for them? So hit that subscribe button, turn on notifications, and drop a comment below. Which part of this new bill impacts you the most? The middle-class savings? The retiree benefits? Or maybe the new deductions for tips and overtime? Let's talk about it, because your financial future is written in the details of laws just like this one.